than honest. Either many of the things I say, people could say I'm stupid for saying them, or maybe I just have the courage to say what I believe. And I have been saying this on your show for a long time. This is confirmation of what I've been saying. The fact that the U.S. just named silver a critical mineral, along with China's tightening exports, there's no coincidence there. This is governments recognizing, I think, silver's strategic importance. Go back a year or two, Canada, many of the miners and players in the silver market in Canada tried to do the same thing, to have it reclassified a strategic metal, not an industrial metal. But this is an understanding, an awakening. It means a floor has been put under demand, number one. You have policy-driven buying now that will be coming in from the U.S. and from other countries like China, who will see that this is musical chairs, if you will. And at the same time, you have a global supply crunch. You got players getting squeezed, and you get China, who is...
Matt Hugon stated that the market is misjudging future interest rates, indicating that, despite short-term market expectations, there is significant political pressure, particularly from the Trump administration, for reduced rates in the future. He stated that the administration intends to designate a more dovish Federal Reserve chair than the current incumbent and believes that the economy is inclined to overheat, which is likely to result in reduced interest rates in the future. This expectation holds considerable significance for risk assets such as Bitcoin, as declining rates function as a favorable catalyst that the market appears to underestimate. He noted that there is an extreme bearish sentiment in the market, particularly among retail investors who continue to be apprehensive and uncertain whether the deleveraging phase has been completely completed. He observes that sentiment tends to reach a nadir when dread intensifies, and prominent voices publicly cast doubt on cryptocurrencies, a pattern that often indicates a market bottom. He observed that the 100,000 Bitcoin milestone holds psychological significance, with selling pressure often observed at such round figures. Once that resistance diminishes, he anticipates a more robust upward trajectory. He stated that the prevailing sideways price action presents a valuable opportunity to establish positions, with the expectation that allocations to cryptocurrency will increase over time. Hugon forecasted that Bitcoin would exceed its previous highs before the end of the year owing to institutional demand, although he does not expect it to attain $200,000 within this period. Regarding emerging cryptocurrency initiatives, Hugon indicated that growth will be distinguished by a focus on assets possessing robust fundamentals and active communities. He expects a surge of new tokens to emerge under favorable regulatory frameworks such as the Clarity Act. Matt Hugon holds the view that opportunities extend beyond Bitcoin and prominent Layer 1 protocols, especially in DeFi, NFT indices, and the creator economy. Changing regulations could stimulate innovation and catalyze a new crypto renaissance, offering the potential for substantial returns in overlooked sectors. Overall, he depicted 2025 as a transition from retail-driven enthusiasm to strategic institutional development, presenting opportunities for long-term investors prepared to endure progressive upward cycles. What do you believe is the most significant obstacle Bitcoin encounters as it transitions into this new, more gradual phase of institutional growth? Kindly submit your remarks and observations in the comment section below. Additionally, ensure that you enjoy this video, subscribe to the channel, and enable post notifications to receive additional videos of this nature. I appreciate your attention.
Brother, and I do. I think we're at a tipping point in the silver market. And I mean, I think you point to the growing shortage of physical supply at the highest levels, the LBMA, the COMEX, and now even the Shanghai market. They're all showing stress, if you will, in supply, and the amount of, or the number of deliveries is off the chart. And coupled with, surging demand for things like industrial investment, central banks, sovereign wealth, the same stuff we've been talking about forever, man. Silver is being pulled from every direction. That's just the bottom line. And not enough talk about it anywhere except on the alternative media channels, so it doesn't gain any traction. But where you will start to see some traction, in my mind, is the fact that the U.S. government just designated it as a critical mineral. And to me, this changes the narrative. Silver is no longer just a commodity. It's a matter of national security, national strategy. And when you talk about the kind of potential that silver has, remember that in terms of market cap, it's the tiniest little nothing market. And when capital begins to flow in, like the United States government and the sovereign wealth funds, it doesn't move gradually. It will erupt at some point. I do believe that. But the bottom line, Jesse, is you got tight supply, you got surging demand at the highest levels, coupled with systemic risk and the LBMA and what could happen if we see a delivery failure, coupled with official recognition. I would say silver isn't just poised to move, it's ready to explode. And yeah, it has been catching its breath. And anything that moved that fast, 40% in a couple of months, is overbought. That's the definition of overbought. And it needed to correct. It did. And here we are back above 50 again. So yeah, I say buckle up for what's coming next. Other than honest, either many of the things I say, people could say I'm stupid for saying them, or maybe I just have the courage to say what I believe. And I have been saying this on your show for a long time. This is confirmation of what I've been saying. The fact that the U.S. just named silver a critical mineral, along with China's tightening exports, there's no coincidence there. This is governments recognizing, I think, silver's strategic importance. Go back a year or two, Canada, many of the miners and players in the silver market in Canada tried to do the same thing, to have it reclassified a strategic metal, not an industrial metal. But this is an understanding, an awakening. It means a floor has been put under demand, number one. You have policy-driven buying now that will be coming in from the U.S. and from other countries like China, who will see that this is musical chairs, if you will. And at the same time, you have a global supply crunch. You got players getting squeezed, and you get China, who is, a big player in the silver market, limiting exports. Yeah, that's a big deal. Now, silver isn't just an industrial metal anymore, Jesse. It's obviously it's strategic, and it's monetary. It's essential. And I think now that governments are making that official, I think from the highest levels, maybe governments just lit the fuse. So yeah, I think it's a big deal. It's a huge deal, bigger than just about anything I've seen in a long time in the silver market.
Andis observations regarding supply constraints, increasing industrial demand, and the rising interest from sovereign investors underscore how silver's function has significantly extended beyond its conventional applications. The classification of silver as a critical mineral introduces a new perspective: policy-driven demand. For the first time, Western governments are considering silver not merely as a volatile commodity, but as a critical strategic resource. That distinction alone ensures a structural bid within the market. As industrial applications in solar energy, electronics, and defense persist in increasing, the supply of tangible silver is diminishing, while investment and governmental demand continue to grow. It is a convergence that virtually guarantees elevated prices in the medium term. However, perhaps even more noteworthy is what Andy describes as the broader awakening, a realization by major financial institutions that the traditional model of portfolio construction is no longer effective. As central bank credibility diminishes, even authoritative voices are advocating for gold exposure, a stance that would have been inconceivable just a few years prior. When Wall Street strategists begin advising gold allocations of 20% or higher, it indicates that institutional capital is reallocating toward tangible assets. This transition, together with the strategic acknowledgement of silver, signifies a fundamental paradigm shift. We are observing a shift from an era primarily characterized by paper claims and debt instruments to one increasingly grounded in tangible reserves of value.
You can find quotes that it's purchased between 6, 7, 800 million ounces in the last 5 or 6 years. Copious amounts. We know that Russia said we're going to add it to our strategic stockpile, being one of the first countries ever to say that. We see massive deliveries. Talk to David Jensen on the the LBMA numbers. Huge deliveries coming off the LBMA in a hugely rehypothecated market where way more contracts exist than bars standing behind it. To your point, we saw Saudi Arabia jump in, and I think it bummed a lot of people out that they bought SLV, but the amount that they bought in SLV allows them to actually stand for delivery. I think there are a lot more countries that have been doing this just on the down low than we are led to believe. You look at China as the second largest producer in the world, flying all around South America, going directly to the miners. Sean Kuhn has talked about this, CEO Dolly Varden, where they go right to the miners, disintermediating the marketplace, buying doré and concentrate right from the miners, paying double what the West will, and sending it back to China to refine it. They control the majority of all the metal refining and rare earth refining, so they just put it on a barge and send it on back to China. But it's coming from the second largest producer in the world, so that should put a little bit of context into it. If they're making that much or producing that much, why fly all the way to South America to pay double what the West will to buy doré and concentrate and send it back for refining? I think you will see that. I think it's been there under the surface if you really dig. But I think a lot of countries, especially those in the BRICS, have understood that, silver is and gold. This is a race for the world's commodities. And it's not just the precious metals, it's the base metals, it's the soft commodities. He or she who has the gold makes the rules, is how it used to be. How about he or she who has all the world's commodities makes the rules in the coming future? And I think that's what you're seeing. So, yes, I do think you'll see more countries and sovereign wealth funds probably at some point. It'll be more transparent what they're doing. But in a world where information travels so quickly, it doesn't behoove any of these players to let anyone know just how much silver they're gathering. And then look at the U.S. I mean, I don't care what anyone says. It ain't about tariffs. I've been saying that for a year now. It is not about tariffs. It is not about arbitrage. Sure, there's a little bit of that truth, but it's being reshored. And, I've been screaming this. Look, all this silver coming into the country can't just be about tariffs. That was the ruse to get it all back here. Some of it's flowed back to ease the burden at the LBMA. But what it really is the smart money trading ahead of the news. Like, they knew that this was going to happen. They knew that it was going to be reclassified a critical mineral. So what do? They reshore it. They say it's tariffs so that London releases it and Switzerland sends it. Oh, by the way, it's reclassified. I mean, everything that at that level that they do, you look at all the massive gold accumulation in 2016, 17, 18, and 19, and then the Basel III reclassification of gold. These things that at the highest level, information is worth more than anything. And the people accumulating it, the central banks, the sovereign wealth funds, they're not just the most well-funded. More importantly, Jess, they're the most well-informed. And I think that's really what you would expect to see, the inside money moving first. And I think we're transitioning to that point where it's now out in the open, at least more so than it's ever been. And at that point, it's anonymity be damned. It's everyone rushed to secure what they can while they can. So, yeah, I think you will see that. No matter what, it's very true. David Jensen does a masterful job of showing that. But in essence, they're trading, 700 or 800 million ounces a day in London. 2 billion a day if you add the COMEX and the Shanghai market. But in London, 700 or 800 billion ounces a day with a float of 150 million ounces. What could possibly go wrong? And so, yes, they are. And I mean, you can simply say the silver inventories are extremely thin, and the pressure is accelerating. It'll be much greater if China and potentially the U.S. curtail exports. Part of naming silver a strategic element is that the U.S. can now very easily, the president can restrict and curtail exports. And this sets the stage for a potentially explosive reaction if demand or the systemic stress accelerates. What is the systemic stress? It's if one of these banks in London has a failure to deliver. And it's not just the silver market. These banks are connected to everything financial. And so you would expect to see a contagion, a systemic reaction reverberating through all markets. But yeah, I mean, the truth of the matter is London has been exposed as far as I'm concerned. And they're hanging on by a thread. There's exponentially more demand than there is supply, and there's exponentially more contracts than there are bars. That is a powder keg waiting to happen. Let's just state something that I've never seen before in my career. And I've talked a little bit about this, but it's worth mentioning to your listeners. Look, in my career, almost 36 years, I've never seen Wall Street or Main Street acquiesce to anything other than 5% of gold, of an asset, a portfolio rather, being in gold. And and it was acquiescing at best. Fine, put 5% of your money in gold. Now, recently we've seen the chief investment officer of Morgan Stanley say, no, sell half your bonds and buy gold. Their new platform, according to him, is 60 stock, 20 bond, 20 gold. You got Michael Hartnett, the chief analyst for Bank of America, with this very, very, very expensive newsletter that goes directly to the institutional trader. It's like many thousands of dollars a year. He's saying, no, it's 25, 25, 25, 25, 25 gold, stock, bond, short-term treasuries, gold. You got Jeffrey Gundlach, the bond king, saying, no, 66, what did he say? Jeffrey Gundlach said, 25% in gold, Monday morning, 25% in gold is not overweight. And then the 6,600 part, that's Jeffries. They used to be a primary distributor for all the world's mints. And they said 6,600 is their next target, at least intermediary target, for where they expect gold to go before it takes a little bit of a breather. You have massive institutional money, traders and analysts and chief investment officers speaking to the most sophisticated traders in North America, saying 25% of your portfolio in gold is not too much. I mean, that's just insanity, if you ask me. Goldman Sachs said, if 5% of the money comes out of the bond market because they fear that there is no independence on the Fed anymore, that gold would go to 5,000 like that. Well, when you have Stephen Mirren sitting in the Fed, who it was Trump's advisor and the architect of the Mar-a-Lago Accord, he fills the vacated spot. What independence? The Fed has no independence. So gold is moving in that direction. You got Bank of America just saying $67 for silver is their target for next year.
The ramifications of this transition reach well beyond investment portfolios. A gradual yet unmistakable shift toward the revival of sound money is currently unfolding. For many decades, gold and silver were regarded as outdated antiquities, marginalized by the financial sector and regulatory authorities. Nevertheless, the same system is discreetly reorienting itself around them today. Central banks are amassing gold at the most rapid rate in 50 years. Sovereign wealth funds and government entities are discreetly amassing physical silver. Simultaneously, public interest, evidenced by the rise in retail bullion sales at establishments such as Costco and Walmart, is increasingly aligning with that institutional shift. The elites, those possessing privileged information, have already taken action. They have been importing billions of dollars worth of gold and silver well before the implementation of official reclassifications and export restrictions. The general public, for the most part, remains essentially uninformed, remains heavily exposed to equities, margin debt, and derivatives. However, as Andy observes, once trust in financial institutions diminishes further, that inertia will change. The pursuit of tangible assets is poised to commence, and in markets as limited as silver, only a minimal disturbance is required to induce a comprehensive supply disruption. For investors, the communication is unequivocal. The opportunity to gain recognition before it becomes more widespread is diminishing swiftly. The insiders have already taken action. The institutions are becoming increasingly aware. The public, as ever, will be the final to respond. However, this time the revaluation may occur more rapidly and with greater intensity than most anticipate. If you found this analysis valuable, please remember to like this video and share it with fellow investors who monitor the gold and silver markets attentively. Subscribe for more in-depth analyses of the macroeconomic forces influencing our financial future. And remain attentive, as Andy Schectman cautions that the subsequent stage of this awakening has already commenced. I appreciate your attention.